But out of the 1,600 pages, there were basically 322 that were devoted to tax credits. So, but it's a fairly significant amount of paper, thanks to my colleague Mark Morton and his previous Dale Steger used to write a lot of tax code or help write a lot of tax code. But Mark will tell you that he's the piano, not necessarily the composer, when it comes to writing tax code. So the tax credits take up a significant portion. Now the good news is out of the 322 pages of tax credits, 155 pages, nearly half of that, are tax credits that were enacted at one time that have either been repealed or sunsetted. So the tax code book is a history book. So we have a lot of provisions in there that are basically repealed code. And I think over 300 pages in the two volumes are related to items that have been repealed by the legislature. So it's, we keep the history going beyond that. So it's not as big as one thinks when you take out the repealed language, but the tax credit section is fairly significant. I started off with the, this comes from the Tax Foundation, and when they're looking at federal tax expenditures, they make the conclusion that there's a lot made about we're giving away too much to corporations, but really 90% of federal tax expenditures actually go to individuals, not corporations. And we'll see how that plays out in West Virginia in terms of tax incentives. Now, I'm going to talk only about tax credits today. The subject was tax credits. There are other types of incentives that go beyond credits, but we're only going to talk about tax credits. And this is the distribution of West Virginia tax credits in 2012, $175 million. Sounds like a big number. We collect over $4 billion in general revenue each year, so relative to that, it's not quite as big. Nearly a third of that was something called the Industrial Expansion Credit, which is a credit, for the most part, beginning in 2012 and going forward, is a credit only for electric power generators. And we tax the electric power industry in West Virginia differently than than the other states tax electric power. In most states, electric power sales to consumers are subject to either a sales tax or a gross receipts tax borne by the end consumer. In West Virginia, for most of our history, at least most of our recent history, last 40 plus years, we've taxed the generation of electricity, not the sale to the consumer. Now, why would we tax generation and not sale? Well, West Virginia Electric Power at one time had a huge advantage over electric power in other states. And at one time, we exported 70% of our electric power to residents and businesses in other states. We still export about 60%. It was a way for the legislature to find means for people outside of West Virginia to help pay our bills through this exporting. And because of this unique tax, we have this tax credit, it's an investment credit that's 10%, prorated over 10 years. So you get 1% a year for 10 years. And it's for the electric power industry. And for the most part, most of that 32% relates to the installation of scrubbers to keep coal-fired power plants open that have been put in place sometime over the last decade. So that's a third of our credits. The next biggest source, and this is only a temporary problem, the alternative fuel motor vehicle tax credit, 20% of the total. I'll get into that one a little bit later. That one has since largely been repealed. Third biggest source is the family tax credit, which is a low-income credit program on the personal income side. The fourth biggest is homestead tax credits. I combine both the homestead exemption credit for senior citizens and disabled, as well as the excess property tax credit. That accounts for 8%. And then finally, number 5 is the economic opportunity credit, which is 3%. Now, for the most part, if you talk to Keith Burdett this afternoon, he may have a little bit of recollection on the industrial expansion credit, but for the most part, he doesn't know any of these other credits. He starts at the economic opportunity credit. Beyond that, we have low-income utility credits. The state of West Virginia offers the utility industry electric power, natural gas, water, and telephone. A tax credit equal to a lower the cost charged to certain low-income residents. That is, they offer a discount to lower-income residents, and it's paid for by this tax credit. So that's a fairly significant program, about 3%. Then the manufactured inventory, 2%. This is where we allow the manufacturing industry to get a dollar-for-dollar credit against local inventory taxes paid on local inventory property. And that's 2%. And then everything else is 22%. Now let's check to what our estimated numbers are for 16. Now in 16, the estimated number comes out to about 146 million. That's a decrease of nearly 30 million from 12. The industrial expansion credit for electric power is still the big source, 36%. The alternative fuel motor vehicle credit's now only 4% and is shrinking fast. It should go away in a couple years. Family tax credit, 13%. Homestead, 11%. Economic opportunity retains its 3% spot. Low-income utilities rises to 4%. Manufacturing inventory, 3%. All others, 26%. Why the big decrease? Well, here's the 5 reasons I came up with as why we have a big decrease in tax credit costs. One is that we repealed in 2013 more than 95% of the alternative fuel motor vehicle tax credit program. And 95% related to a little provision in the code that allowed flex fuel vehicles the tax credit. The other 5% was everything else. Plenty of flex fuel vehicle models out there people bought. They didn't even realize they had a tax credit until probably the end of 2012, even though they bought the car in 2011. Significant cost to the state treasury. There are factors going on in the electric power industry that's going to reduce the industrial expansion credit in later years. No more business franchise tax. When we reduce or eliminate taxes, there's no room for tax credits that relates to those taxes to go, so they go away as well. The lower corporate tax rate reduces tax credit costs. And then we also have eliminated several tax credit programs. Alternative motor vehicle credit. From tax year 2011 to tax year 2014 to date, about $75 million in cost. And that was, for the most part, a $7,500 tax credit for buying a natural gas, electric, hybrid, or flex fuel vehicle. Commercial vehicles is up to $25,000. Most of the claims were not at the business level; they were at the individual level. There was a home infrastructure credit up to $10,000 and a commercial infrastructure credit of up to $312,500 per installation. This was modified in 2013 with an accelerated sunset date for anything that remains of December 31, 2017. The tax credits are now restricted to natural gas vehicles. Very little cost, very few natural gas vehicles. And commercial infrastructure related to natural gas of up to $400,000 per installation. There's not too many of those installations. So the credit is greatly dissipating. There's some carryover amounts that will play out for a couple more years, but for the most part, the bulk of the cost is over with. Electric power industry, again, I explained that credit's 10% of capital investment. You get to claim it over 10 years. Applies against B&O tax, which is unique to West Virginia. Most of the, at least the more recent huge investments in scrubber technology and environmental remediation took place between 2007 and 2009. The 2007 tax credits expire after 2016, and the 2009 credits expire after 2018, a 10-year period. Now, if for some reason the legislature were to repeal this program tomorrow, the expected gain from 1 year, I would assume we would grandfather all old credits. The expected gain from one year, the first year, would only be in the $2 to $3 million neighborhood for a program that's over $50 million in cost. So this would be any gains would be phased in over a longer period of time. But I expect this electric power industry tax credit to decrease by nearly 50% by 2020. No more business franchise tax. That tax absorbed significant credit claims, averaged about $14 million a year since 1992. Between 2008 and 2012, still between 10 and 15 million a year. It was more than 13 million in 12. Well, as of the beginning of this current calendar year, there's no more business franchise tax. So those costs go away with the tax. The lower corporate tax rate a few years ago was as high as 9%. In fact, even back in the early 1990s, it was 9.75% at one time. It's now down to 6.5%, and ultimately that tends to lower the amount of credits or the value of credits against tax. The 2008 to 2012 average is less than $9 million a year. So you're fairly small. And then we have legislative action repealing tax credits. This is a list of repealed programs. And I won't go over all of them, but there's a whole bunch there. The ones that are highlighted in a sort of a, what kind of color is that, Mark?
Burnt red.
He says burnt red color. Those are credits that never had any cost. That is, no one ever took advantage of them that we're aware of. But they were in the code for a few years. And there's a whole bunch on that page, and there's a whole bunch on the next page. And again, on the next page, a whole bunch of credits that never were ever used. The residential solar energy program actually sunsetted itself. It was in the code. There was an expiration date in July of 2013, and that went away on its own. I have that that's really a green credit. The green credits are basically what I call individual tax credits. Not so much business credits, but credits that I would say have a tendency to benefit individuals. And I would put the alternative motor fuel vehicles, even though some businesses benefited from that, more of as individual credit, and that's got a sunset date of 2017 for what's left there. There are a number of programs that have no sunset date, including industrial expansion revitalization. Industrial expansion was initially created in 1969. I was not around here in 1969, but I believe that probably it was one of Governor Moore's programs. He had a big battle with the legislature about that time. And in exchange for the introduction of the industrial expansion credit, which at that time applied against B&O tax of manufacturers who paid B&O back in those days. But in exchange for that, the state, for whatever reason, repealed the direct use exemption for purchases made by manufacturers and other industries for 2 years. So there must have been a little bit of a trade that went on back then. But that's the oldest credit. 1969 is when that came into play. Then we have the low-income utility credits. There's a telephone low-income utility credit, but in the telecommunications industry, there's been a tremendous amount of deregulation. We no longer have the old-fashioned Ma Bell. And to my recollection, I haven't seen any real significant claims of that credit in recent years because it's deregulated. In fact, you can get a cell phone for free under certain state and federal programs. Neighborhood investment would be an individual program. Neighborhood investment has an expiration date of 2016. So there's a good chance that in the 2016 legislative session, there'll be some folks that'll be asking the legislature to extend that program. Usually that's what happens when something expires, or set to expire. And then a number of other programs that are not sunsetted. The film industry program I have in blue because that's a transferable credit. Commercial patents, another credit that's set to sunset in 2016. We'll see if anybody comes and asks about that credit. By the way, on the commercial patent side, there has been virtually little or no activity to date. Mine Safety Technology has a sunset of 2018. The energy intensive industrial consumers is 2021. However, the client that was going to benefit from that is no longer around, so that credit has basically been a zero since it started. Tourism development, current sunset date is 2019. Again, rehabilitated building credits are also transferable. There's no sunset date on them. And then there's some other credits that are basically benefiting individuals like non-family adoption, senior citizen homestead, low-income family, and excess homestead. There's a credit out there for utility taxpayers with net operating loss carryover. That's mainly the electric power industry. And that's a really interesting credit. It's a 0.25% multiplied by your tax liability. We had complaints from the electric power sector that with the legislature reducing the corporate tax rate, was originally 9% down to 6.5%, that it was costing them money because in a regulated environment, net operating losses are treated as an asset, and the utility in its book sheets with regulatory authorities, valued the asset at 9% times whatever the net operating loss was, and now you're going towards a 6.5% rate to be valued by net operating loss. So the legislature created a tax credit. I'm not sure it's ever really fully worked for industry that was interested in it. That would give folks a little bit of a tax break on their net operating loss carryover because of the lower corporate tax rates. Until that net operating loss, I guess, disappears. There's a military incentive program, which has always gotten very little use. Typically, the way the code reads, if you're a veteran of the Korean War or Vietnam War and you need employment opportunity, or is employment opportunity available. My uncle was a veteran of the Korean War, and he's not interested in employment these days. They're also unemployed members of the National Guard qualify, but that program really has never gotten a whole lot of interest on the part of the business side. And then we have a wind power community contribution credit. That's I put a sunset date of 2017 because it only applied to wind power facilities that made certain qualified community contributions prior to some date in 2007. And you only can use the credit for a period of 10 years beyond that. So by the 10-year period expires in 2017. To my knowledge, no one has taken that credit to date. So let's move to 2020. Assuming no policy changes to add or modify programs, which is a false assumption, there will be changes. Folks are probably creating some new programs for introduction next year as we speak. The industrial expansion credit falls to about 29%. Again, that relates to a special program or a special tax, B&O tax that applies. But really, the family tax credit, the low-income utility credit, the homestead credits, yeah, it does up on share. You get about half of the value of the credits are going to be low-income related credits for individuals. So the other half of 48 million, about 30% of nearly 100 million is close to 30 million. So only about 18 million for everything else. Very small. And again, as far as Secretary Burdett is interested in, he's interested in economic opportunity credit when he goes to sell credit ideas to clients. He's interested in manufacturing inventory credit. He's probably interested in manufacturing investment tax credit. Those are probably his three major programs that, in terms of tax credits involved with economic development. And from a tax administration standpoint, every state has some sort of tax credits. There's no state without some. It's sort of like being a salesman. You're trying to sell something. In this case, the commerce folks are selling the state of West Virginia. And it's like opening up a checking account at a local bank. And this bank offers me a free toaster oven, and the other one offers me a cooler. It's something that's thrown in with the deal to make it work. But ultimately, I think the tax structure is probably more important overall than the tax credits in terms of the tax credits are sort of that added thing to make a sale, to bring somebody to West Virginia. I don't think in and of itself it determines whether or not someone's here. There have been many years ago when we had the old super credit, which theoretically promised 50% credit. There was a business that I think bought into the idea that the tax credit's all that they needed, and they built their business, built a nice business, but they failed to do any marketing studies or any analysis, and the business went bankrupt before it got started. But they were sold on the tax credit. So the tax credit only works if you have tax liability. Doesn't work if you do not have tax liability. And oftentimes you get a company that comes to West Virginia, XYZ, and there's a headline that comes from the development office. They got various programs, including maybe economic opportunity credit. If you go through the math, they get a $50 million economic opportunity credit. So the headline in the newspaper, we give away $50 million to XYZ. Well, the real determination of the tax credit is not the calculated tax credit, it's the tax liability in which the credit can be used against. And if XYZ's got a net operating loss for the first 5 years, and they have a couple other years where they have little or no corporate income tax, it may be $20,000, $30,000 by the end of 13, 15 years, not $50 million. Depends upon the tax liability at the state level, not local level, state level. So ultimately, those headlines are paint a false picture on the tax credit side. And the overall value of the economic opportunity credit is what, $5 to $6 million a year, spread out over a couple handfuls of businesses. Those are not the 50 million variety types. So that's my little commentary on that. Conclusions on tax credit expenditures: the values are decreasing due to emphasis on lower tax rates, no business franchise tax. Legislature in recent years has either repealed statutes or put sunset provisions in many of the programs. So the outlook for 2020 is a decrease of about 45% from 2012, or nearly half. Roughly half of the credits are going to relate to individuals. Electric power accounts for another 30%. Roughly $20 million relate to economic development. And those are the economic development programs, basically economic opportunity, which is a job creation credit, manufacturing investment, manufacturing inventory, which is basically a credit for taxes paid at the local level, film credit, tourism credit, historic building rehabilitations. And again, Secretary Burdette is probably going to focus mainly on the top three, not so much the bottom three, although he is involved in the administration of at least two of the bottom three. The historic preservation credits are actually administered by Culture and History, not by the Development Office. Anything else I can think of that I've failed to mention? On the economic opportunity credit, if you basically get a credit for creating jobs. If you fail to create the jobs, there's no credit. And the credit, if you're an existing business that expands, the credit is for the portion of the expanded business, not the entire business. So it's the new stuff that's added, not existing activity. The manufacturing investment credit is a credit that applies to all manufacturers. It's an investment tax credit, whether it's the small manufacturer around the corner or the big manufacturer that just opened up down the street. It's used against corporate income tax. It's a 5% investment tax credit. Offsets up to 60% of corporate tax liability. If we were to migrate to a single sales factor, probably the manufacturing investment credit would be worth very little, because I think a big winner under the single sales factor would be the manufacturing sector, to the extent that they may have few sales in West Virginia.